There we go. I don't know why I'm tiny and small again today. Hold on, let me remove me from stage. Maybe put. Ah, well, whatever. Let me see if I can remove that. There we go. We got it corrected. All right. StreamYard is kind of tired like I am today. So good morning, everybody. I am here in the beautiful Acapulco, Mexico. Yesterday, it was a long travel day. So the Uber picked me up at 4 a.m. from my house in Daytona Beach and headed over to the Orlando airport, hopped on the flight, went to DFW, and then DFW direct to Acapulco. So it was just a long day. And then when I arrived, the first thing that we did, we loaded up in the car and we went down to the Eco Beach. So that was a lot of fun. So first thing I did when I got here is I was swimming in the ocean, and then we came back to the villa. We had a little bit of pool time, and then we ended our night with dinner. So I'm here for some speaking in a mastermind that I'm a part of. So I'm here for 2 weeks. So this week and the next week, we're going to be posted up out here. And I was happy to hear that I thought I was still on mountain time when I was going to be here, but I'm actually on central time. And I was like, perfect. I get a little bit of extra time to sleep this morning. So let me look at these comments. Let me see who's coming in. Good morning, Mr. Dexter. How are you today? So today I have a really fun and exciting episode because this is something that I've just been personally going on a big deep dive on, and it's the whole world of our taxes. Because I mean, honestly, taxes are our biggest lifelong expense. It's bigger than our housing, our food, the multiple cars that you're buying for yourself and your family. And if taxes are going to be our largest expense, shouldn't we understand them, and shouldn't they also be our biggest opportunity? I kind of had like that big epiphany moment when I was going on this deep dive of the taxes, because number one, I hate getting hit with my IRS tax bill. Okay, so how can I legally minimize that? And then just going through and understanding that honestly, taxes and the infinite banking concept, they're kind of one and the same when you think about how you need to go do your own research and your own deep dive, and you can't really just depend on somebody else to give you and feed you all of the answers, because that was the big epiphany that I had. I mean, honestly, I'm on my third tax professional now, being only 26 years old, because these other people, I'm realizing that my accountant is not there to give me the tax strategies. Really, what they're just there to do is work with the information that I provide them. And then they go in, they file everything, and they say, okay, this is how much you owe. So I'm really going on this deep dive just for my own personal sake, so I can keep more of the money that I'm making, right? That's the similarity between IBC and taxes is that if you really understand it, you can keep more of the money that you're making, because that's all we're after, right? I mean, hey, I'm out here, I'm working, I'm grinding away, and it doesn't matter how much I make, it only matters how much I keep. So the big example I always like to use, it's actually from my father when dad was running the chiropractic offices. Yeah, he was a very successful chiropractor, making over $1 million a year from the 5 clinics. But who cares if you're making $1 million if your overhead is $975, right? So it's just, how can I keep more of the money that I'm making? So I have been going in this deep dive, and I've been loving this book. It's called Tax-Free Wealth by Tom Wheelwright. Okay, Tax-Free Wealth by Tom Wheelwright. Now, Tom Wheelwright, he has a podcast. All right, so just FYI, go look him up on your podcast platforms. But he is Robert Kiyosaki's tax strategist and tax advisor. So, and I just love how Robert Kiyosaki thinks, right? Just with his mentality around money and how to use leverage, how to really understand what the government is wanting us to do, and how can I invest and move my money to get these tax incentives. So I'm not completely done with the book. I'm about, I don't know, would you say almost halfway there, almost halfway through the book right now. But it's a lot of information. And so I'm keeping an open mind as I go through this. And honestly, some of the stuff that Tom Wheelwright is saying in this book, I kind of giggle at. I've been kind of making a little notes because I'm like, oh my gosh, this is my father, with some of the stuff that dad always says. What's one of them? He says in this book, pigs get fat and hogs get slaughtered, and you want to be a pig and get fat. You don't want to be a hog that goes out and gets slaughtered. Yeah, here it is. Tax strategy number 8 from chapter 8. And I circled it because Brent Kessler says that line all the time. And so I was reading it on the airplane. I was kind of giggling to myself. And he says, pigs are your pals. Pigs are passive income generators, and pals are passive activity losses. So anywho, I highly, highly recommend this book. All right. It's available on Amazon. Go and just research it. All right. For my real estate professionals, my business owners, this is definitely a resource that I would get into. I actually bought one for my mom. I shipped her the book to her house from Amazon. But I wanted to go through one specific segment within his book today. And before I get into it, we're going to kind of talk a little bit about average rates of return versus actual rates of return. And we're also going to get into depreciation, bonus depreciation, right? That was the big subject of this year when Trump came back in with that one beautiful bill and that 100% bonus depreciation came back. I actually filmed a podcast episode with a close girlfriend of mine. Her name is Miranda, and Miranda lives in Florida with me. She's a realtor out there. So shout out Miranda if y'all are looking for any properties in the Jacksonville, St. Augustine, Daytona Beach, along that coast area. Miranda's your girl. I'll get you in contact with her. She's a great, great realtor. But she came on and she was just talking to me about this bonus depreciation early on within this year, because it was just something that we don't talk about it. We're not hearing about it. And if you are, you're in the correct rooms. But at all of these events that I go to, I hear a lot about these speakers talking about how to make money, how to make your money work even harder for you. But not a lot of people really get into the nuts and bolts and the nitty gritty on the tax side of everything. So that's what I spent this whole year doing. And especially because we're right now here in December. Hello, December. It is the perfect time to really get into those final purchases that you can be making so that you can minimize your tax liability. So I actually want to bring up, let me share this screen real quick. Here we go. This was an article that was sent to my email. It's a company that buys and sells airplanes. Okay. And they sent out this article like in their mass newsletter, year-end advantage. How does bonus depreciation make November a prime month to buy a jet? And this article was posted on October 22nd of 2025 of this year. So I really like how it got into this article here. And let's just talk about what is bonus depreciation. All right. In simple terms, bonus depreciation is a tax incentive that allows businesses to immediately deduct a large portion or even the entire cost of an eligible asset in the year they are placed in service, rather than spreading the deduction over several years. And according to the recent legislation, which you may know of as the One Big Beautiful Bill, 100% bonus depreciation was restored retroactive to January 20th of this year. And as part of a broader federal tax reform initiative. So this means qualifying taxpayers who acquire and place a business aircraft in service before year end may be eligible for a full deduction of the purchase price in 2025. So honestly, shout out to this aviation group, because this is beautiful marketing, right? I mean, hey, if you are working with a whole bunch of business owners and they're looking for some tax deductions. Hey, come and buy an airplane from us because, yeah, you can use it for your business expenses. You can use it for your business life and then even also your personal life. But there's also this big tax incentive that you can get from it as well. So in this article, they just break down, that we can really go and get some tax advantages from buying airplanes. So this is something that I'm going to do at some point in my life. I would love to own my own airplane. I'm going to hire my younger brother to be my pilot. So that's what really got me on this whole wavelength of looking even at those larger expenses. I mean, when I bought my van this year, that van is over 6,000 pounds. I can take that purchase of the van and actually write it off and take those deductions on my business side. Because, hey, in my van, I record the podcast, I travel around in it, and I go speak at different events in it. So it is really used as a business expense because I use it within my business life as well. But what's funny, to go back to my irritation with these tax people, it's like, guys, why wouldn't you tell me this? You know what I'm doing within my financial life. And honestly, to me, it just seemed like they had all of these different clients and they didn't really care about me. I'm just a number to them. But it just pissed me off that they were not telling me that I could do some of this stuff. Because even the first van that I bought, that was back in 2021. Why did we not get that depreciation back in 2021 when I bought the van in the first place too? Now I'm on the second van. I think y'all know that story, but I don't know. It just really pisses me off. So my advice to y'all is take ownership over your taxes and understand it for yourself. Do your own due diligence, get educated, because no one's going to care more about your tax life than what you do. Okay. So that is just my big PSA, I guess, of today before I get into some of the content that I want to talk about. But, the difference is really between the wealthy and the masses is that the wealthy don't avoid these taxes by accident. They really follow the tax law and these incentive, I can never say that word, incentives built into the tax code. So, most people, when we're going out there and we're doing our investing, even, we're investing, but we're not considering the taxes and the guarantees of those lower returns if we're not incorporating in those taxes. Okay. So I want to bring up my other screen here. Let me share screen. And it's this window. Beautiful. Okay. Open it up. All right. Because what I'm going to do is I'm just going to really compare stocks versus real estate. All right. And I'm going to go in here and read a snippet from Tom Wheelwright's book, Tax-Free Wealth. It's literally in the first chapter on page 8 and 9. Okay. So you'll get into it once you purchase this book and go read it. But hey, we got some more people coming in this morning. Good morning, Mr. Shane. Oh, it's icy over there. Shane, I hate to break it to you, but today's going to be 87 in Acapulco. Dexter's saying high paid order takers. And then Lisa saying good morning. Good morning, Miss Lisa. Hey, I'm back in our beautiful place. We got to come back out here in 2026. Okay, girlfriend? All right. So in this chapter, and it's literally tax strategy number one. Tax strategy number one. Include tax planning in your wealth strategy. Too many people ignore taxes when investing and planning their wealth strategy. They look at the return on investment as the return before they pay taxes on their investment income. This makes no sense. With taxes as your biggest expense, wouldn't you want to look at every return on every investment after taxes? When you do, you may find that you are making a lot less on some investments than you thought you are making more on others in comparison. So let's take a couple of examples in the US that we will go into in much greater detail later on in the book. First, we're going to look at this real estate investment and we're going to compare it to a stock investment. And if you were to compare it directly to some other investment before tax and without leverage, you would have to agree. So here's the example. Let's say you purchase a rental property for $500,000. So look at my document over here. You have this property that's worth $500,000. That's the purchase price. You invest your own money of $100,000 and you have the bank to finance the remaining $400,000. And when you get into this rental property, you're going to make an annual return of 7%. Then let's suppose that you make a similar investment of $100,000 into the stock market that returns 10%. Which investment is better return? It seems obvious that on the stock market return of 10%, it's clearly better than the real estate return of the 7%. Right? Because, okay, if I go in here and I have this real estate of the 7% on my 100,000, that's going to be $7,000 versus the stock investment, 10% on 100,000 is that $10,000. But let's also talk about this. Do a quick little insert here. I want to first get into the differences between average versus actual rates of return. And if y'all have read the book that my father and Chris Noggle wrote together, Mapping Out the Millionaire Mystery, this is a segment that we get into in that book as well. Send me an email and I will send you a copy of that ebook. Here's my email posted up right there on the screen, hannah@themoneymultiplier.com. But a lot of your financial advisors, they're coming to you and they're saying, hey, give your money over here to me and allow me to invest your money into the market. And I'm going to get you an average rate of return. And traditionally, and I was looking it up this morning, the traditional over long haul of having your portfolio within the stock market is an average about 8%. But I'm going to go above and beyond. I'm going to be your financial advisor and I'm going to come to you and I'm going to say, hey, give your money to me. And we're not even going to include the fees that I charge and the taxes you got to pay. But I'm going to be your financial advisor. Give your money to me and I'm going to get you an average rate of return of 25% over the next 4 years. When you first hear that, you're like, holy crap, okay, 25% over the next 4 years, that's great. I would want to do something like that. Well, let's walk through what a true average rate of return actually means, because what I'm more concerned about when I'm investing is I want to know what my actual rate of return is, and we'll get into it. So like year one, for instance, let's say that I just use dollars. You can say it's $50, $50,000. It doesn't matter. But let's say I put $50 into this stock and over that year, it grew to $100. So I put in 50, it grew to 100. Well, hey, that's 100% return on my money that year. I just doubled my money. All right, I'm doing pretty good. But then year two, I start off with $100. But then the market goes down, right? Because we can't control the market. Those are things that are outside of our control. So the market goes down and now I am back at my $50. So my rate of return for year two is minus 50%. That's what my growth was within my portfolio within year two. Year three, I'm starting out with the $50 of where I ended at year two. I'm starting out with $50. It grows to $100 now in the third year. So my growth that year is 100%. I just doubled my money again. And then year four, I start off with my $100, but then the market tanks. It does its thing that it does. It gets all sassy and crappy. And then now I'm back at my $50. I'm minus 50% this year. So look at this. If I add up this 100% minus the 50, plus the 100 minus the 50, that's 100%. If I take that 100% and I divide it by 4, I just got you a 25% average rate of return. I told you what I was going to do, and I kept my promise because I told you I was going to get you a 25% average rate of return. But let's look at the actual rate of return. Year 1, you started with $50. Year 4, you're ending the year with $50. So what's your actual rate of return by doing this? 0. Not to mention probably less because of the time value of money, inflation, and all of that jazz. But we got to look at the actual rate of return when we're walking into investments. And I hate when people use average. Y'all, you can't take the averages. You got to take the actual rates of return. When I walk in, how much money am I putting in? And then when I leave and exit this investment opportunity, how much am I leaving with? And what is that actual rate of return? Okay. I'm off my soapbox. I just wanted to get into that because that's another thing that kind of drives me just a little bit nuts. Let's go back to my comments here. Yes, average is not actual. So to get back to the example of the real estate investment versus the stock investment, you would think that this real estate investment, 7% versus the stock investment at 10%, I'm going to be better on top with my stock investment, right? Before the taxes, we have a $10,000 gain on the stock investment. But let's say we're at a 20% tax bracket here. We're paying the 20% on the taxes. So if I include that 20% for the taxes I got to pay, my total gain in my stock portfolio is $8,000. Let's go a little bit deeper into the real estate investment though. My real estate investment, if I include in some of these tax incentives that I can use from the tax code. So let's read on. Only your real estate investment doesn't just give you tax-free cash flow. It actually reduces your taxes on your salary and or business income, because while there is still positive cash flow of $7,000, the depreciation deduction of about $27,000 gives you a tax deduction against your other income of $20,000. So what he's saying is that, hey, based on this property and where you're at within your tax bracket, you actually have a total of $27,000 of total depreciation. But we got to minus out the $7,000 that you're producing in that rental income. So that $20,000, the difference, 27 minus 7, that $20,000 additional deduction against your other income is worth $6,000 of reduced taxes on your other income in a typical 30% ordinary income tax bracket. Okay, so your real return for your real estate is $7,000 plus an additional $6,000 of a tax refund on taxes you normally would have to pay on your salary and business income, for a total return of $13,000. So here's where it gets into it. What's the higher number here? Is it $13,000 that I'm keeping, or is it $8,000 that I'm keeping in my stock investment? So you gotta work, number one, with a good tax professional. And y'all holler at me if you're needing people. Okay, I can turn you on to some of my tax experts and even the people that I and my family uses. But when you start taking into account the tax side of these investments that you're doing, what is that actual rate of return? See, and this kind of just goes back to like even Nelson Nash's teachings, where he talks about the rate, and everybody loves to get hung up on rate. But it's not that rate that's killing us. It's the volume of that interest that we're sending out the door to other people. So here in this example with my rates of return, people people will think, oh, 7% compared to 10%, I'm going to go with the 10% because it's a higher number. But they're not thinking deeper into those layers of what they could actually be doing if they take into the tax considerations when it comes to their investment portfolio. So does that make sense? Now, given I'm still a student of this is stuff that I am actively doing in my own life, and I'm bouncing these ideas off of my tax professional of who I'm using. But even like my mama, why she was so pissed off as well is she's like, oh my gosh, we've had these rental properties. I've had this rental property since I've been living in Kansas City. We moved to Florida in 2017. I've had them all these years, and nobody has ever came up and talked to me about bonus depreciation, cost segregation. So like, what the F, man? I want to know some of these things so I can keep the money that I already have. So I just want this to be an eye opener as you get in here into December, because remember, we're here at the end of the year. Ask your tax professionals, hey, what do I need to do? What is my tax liability for this year? How much real estate do I need to go and buy because of this? I mean, honestly, Dad actually purchased a property. He's not going to make money off of it just by the rental income that's coming in, but where he makes his money at is by the depreciation and the write-offs that he can get from that real estate transaction. So it makes sense because, hey, if I can use this rental property, no, it doesn't make sense from a I don't want to say from a business perspective, but I guess just looking at it as me just buying the piece of property and just looking at the cash flow coming from it, it doesn't really make sense. I'm not making any money there, but how I'm making up the back end of the money is by the taxes that I'm able to save and I no longer have to pay because I went out and I did this real estate transaction in this venture. So I don't know. I hope this is just helpful for y'all because it has been eye-opening for me. Because given graduating from a public school, dropping out of college, they don't teach us honestly about taxes. And I was actually in college, I was pursuing to be a CPA and a accountant, and we really didn't even get into all of this stuff. Now, given maybe I dropped out too soon before you got into it. but I just remember sitting there in college, and I just remember learning about accounts receivable and accounts payable and all of that stuff, right? I don't know, this interests me more as I really want to take advantage of the tax code as much as I can. And I forget the saying, but there's a saying within this book here. I'm gonna butch up the number, but when you look into like the big tax code book itself, there's only a limited amount of pages that actually talk about us paying taxes, but the rest of the book and like the rest of those 1,200 pages goes towards actually telling the American people, hey, go and do these specific line items. Here, and I'm going to bring up my notes because I wrote this all down. So the tax code is not a punishment, it's a list of incentives. So the government wants us to produce housing, right? So it rewards the real estate investors. They want us to create jobs for the economy and the people. So it rewards business owners. The government wants us to produce clean energy. So that's why the oil, the gas, the solar is so great when you're looking for tax benefits, when you're doing your investing and also looking for cash flow. And, even farmers, the government wants us to keep producing food. So by them doing that, they're giving tax incentives for it. So matter of fact, speaking about the energy, y'all, in Tampa, okay, just FYI, I have my oil and gas professional coming out and sharing. Her name's Courtney. Courtney's coming out and she's going to be sharing how we can invest in oil and gas and how you can take a lot of these tax incentives by investing and also making some returns. So if you've been kind of sitting on the fence and you want to come out to Money Game Live, go and snag your tickets because, tickets are selling like wildfire, which is great. I appreciate it. I'm very excited to see all of y'all. But Money Game Live, Courtney's going to be coming out and she's going to be talking specifically on the oil and gas side for our investments. And then also, if y'all know the gentleman, Mr. Don Pendleton, what's so funny is I've been seeing Don around for so long. Like, we will go speak at the Ohio RIA and different events around the country. And I see Don's name all the time. And I see him walking around. But when we were in Arizona for the residential assisted living convention, Don was speaking as well alongside us. And I was like, okay, Don, I see you everywhere. We just got to have this conversation. Let's just talk. And I love that man. He is a hoot and a holler, let me tell you. So Don is going to be coming out and he's really going to be talking about the tax side for real estate, oil and gas, your business income, W-2 salaries, what you could be doing. So if you're looking for tax strategies, just FYI, Don's going to be in the room and Don's going to be shedding a lot of light and providing a whole bunch of value. I'm going to be sitting there with my notepad and just taking notes, honestly. So that's coming up, all right? End of February, moneygamelive.com. So go and snag your tickets there. So I've said this before on the live stream, but this quote from Tom Wheelwright's book also really hit me too, where he goes, you know, legally not paying taxes is the most patriotic thing that you can do. Because as I mentioned, when you follow the tax code and you see what the government wants you to do, that's where all these tax incentives come about. So if I can provide housing, provide jobs, provide food and clean energy to the country, the government's going to incentivize you for that, and they're going to give you those tax breaks, those tax deductions for doing so. So it was just, once I heard that, and when I was reading this early on about a few months ago, I was like, boom, 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 boom. Light bulb moment went off. I'm getting it now. I'm getting it now. So it is, I'm understanding more and more about this big, beautiful bill with 100% bonus depreciation and how powerful it truly is for my high wage earners, my high business income earners, and how we can really start taking advantage of it. And really, with this bonus depreciation, it allows you to write off most or all of the value in 1 year. So talk about this with your tax professionals, okay? If you are into real estate, you have a vehicle that's over 6,000 pounds, you're using it for your business, you know, you have business equipment, like my chiropractors, you know, some of y'all got those big x-ray machines, right? How can I use some of that in this bonus depreciation here? The cost segregation with the furnishing, the appliances, the improvements that you're doing within your rental business, or even maybe you have like a brick and mortar office, and how can I use some of those tax incentives as well? So how does this kind of marry when we're talking about taxes and the infinite banking concept? Because as we know, the infinite banking concept, it's my liquidity system, if you will. I would even argue to say it is also my cash flow system too. Because think about this. If I go back to this example, let me share the screen. If I go back to this example, and let's say that I pulled this $100,000 that I invested into the real estate, and I pulled it from my policy first, remember, you're still earning interest and dividends, tax-free, uninterrupted compounding on that $100,000 that you pulled out. You're still earning and making interest on that money, even though you're using it in the real world and you're using it to buy your real estate investment. Because reminder, all right, if you're new here, hello, it's wonderful to see you. I'm here every Thursday morning, 9 a.m. Eastern time for Money Mornings with Hannah. Come and join us. But if you're new here, especially when it comes to the infinite banking concept, This is why we take out policy loans and we're not just withdrawing the money out. Because what I'm doing when I take out that policy loan is I'm putting my death benefit on my policy up for collateral, and I'm taking a loan from the general funds of the insurance company. So I'm using their 100,000 in the real world, and that's how and why my 100,000 still remains in the policy to grow and compound as if it wasn't even touched. So with this 100,000, you got to start thinking like the banker, right? So with these returns on my gains that I'm producing from this real estate investment, I'm going to take some of those gains and I'm going to go and put it back towards my policy, paying back my policy loan. Do I have to pay back my policy loan? No, you don't have to pay back the policy loan. And sometimes it might make sense not to if I just consistently have that money out there moving for me in motion. But just remember, don't steal from your own banking system. Be smart with your money. And don't be afraid to pay back those policy loans, because what I'll do with my interest income that comes in from my lending deals, I will use some of that to pay my expenses, and then I'll use some of it to go and pay back my policy loans. And I do it because then it builds back up my liquidity system, if you will, so that when another opportunity comes and I want to go fund another investment deal, or if a big bill comes due, because something happens, we get emergencies through life, and, maybe the tires on my car, they all need to be replaced. I mean, it's going to be a hefty bill, right? So this is just a place of where I store and I keep and I protect my money. And then through the policy is how I go buy these investments. And just by simple layman terms, I just kind of say that I'm double dipping on my money by doing so that way, because I'm making interest in my policy and I'm making interest over here in the investment deal. But with the tax planning is creating a cash flow system as well. But as I said, I would also argue that the policy is creating a cash flow system too, because you get to the point within that policy that you can take out more than what you even put into it. So if I put in, let's say, $10,000 of premium into my policy one year, and my cash grows by $12,000 tax-free, that extra $2,000, I just count that as extra cash flow to me, right? Prime example, I'm so excited because we're getting in here to the end of the year, and then 2026 is going to come. My mama's oldest policy, it's 17 years old this year in 2025. Next year, it'll be 18 years old. But when mom put $1 of premium into that old policy, her cash value grew by $2.49. So essentially, she put $100 into it and the cash grew by $2.50. What's that rate of return, and what's that cash flow liquidity system, right? And I was kind of like toying around with this idea this morning when I was straightening my bangs. My bang people, bangs are a lot of work. You got to straighten them every single day. But I was even thinking to myself, I was like, you know what? There's a reason why they call it whole life, because you can use it for your whole life. Now, given when we're talking specifically about the infinite banking system, I want to design the policy properly so I have immediate high cash value that I can take out right away. But even if it's just a 100% base premium policy, that policy is still going to build up cash value, and you can still leverage and use the cash value during your whole entire life. So there's kind of a reason why they call it whole life and not death insurance or death life, right? They should honestly call term life death life, if you think about it, right? So we just got to start rethinking the thinking, okay? That's what Nelson talks about all the time. Rule number 5, rethink your thinking. So as my ADD is going off, I'm seeing some comments come in. Oh, good, Shane. Yeah, no, this is a good point. He says, I don't have additional real estate yet, but I do use the Augusta rule as a smaller business owner. That's a very good one, the Augusta rule. Actually, in Tom's book, he talks about the Augusta rule as well, and that's a good one to take advantage of. Rent out your house. I think it's like 12 to 14 days. Don't quote me. I'm not a tax professional, not a tax expert. Go talk to one. But the Augusta rule is a great place to start as well. CPAs don't know this stuff. It has to come from a tax strategist. Yes, absolutely. And we're learning that the hard way. But because that's the thing, right? You think your CPA is going to be your tax strategist, but they're not. And Dexter's saying for the van, wrap it up, put the QR code on it, all business van. Absolutely, man. That's what I'm thinking about doing. I have actually this little strategy. I don't know how much my Bronco weighs, but I'm thinking I have like a little marketing strategy that I would love to do on my Bronco on a tire cover. And I'm thinking that I'm going to do a tire cover really promoting, hey, learn how I got all the money back for this Bronco that I bought for myself. And I'm seeing how I can use that for some tax incentives for even like my Bronco purchase. I don't know. Just some ideas I've been toying around with. So again, when you combine the two systems, infinite banking along with your tax planning, borrow against the policy, invest it into those tax advantaged assets, use the bonus depreciation to offset income, and then pay yourself back. So then that you're reusing the capital again. I mean, taxes really reduce your wealth, but when it comes into the infinite banking concept, you can really recycle your wealth over and over again. So together, they create that unstoppable wealth building for you and for your family. So this is my goal. I keep thinking about this when I'm reading these books or I'm listening to the podcast, especially about tax strategies. Like, I don't know, like for us youngins, there's a gentleman on YouTube. His name is Caleb Hammer. And I like watching him. He's pretty entertaining. And what he does is he sits down with people and he goes through a financial audit. So go look up Caleb Hammer. And there's also another gentleman, Greg. Is it Greg Steffens? Greg Steffens, I think I'm butchering the first name. But he's also another gentleman that talks about the money lifestyle and financial audits for people. But nobody ever really talks about whole life insurance. And my goal and my mission that I'm on, being a youngin here in the United States, is how can I make the infinite banking concept in whole life insurance more of a mainstream topic? You know, what can we do to get this into the eyes and the ears of people like Tom Wheelwright, the people like Robert Kiyosaki's, you know, not to bring this up, but I mean, there was actually, when we had our last mastermind event in Nashville last year, Nashville's only 20 minutes away from Franklin, Tennessee. And so I actually reached out to Dave Ramsey and his office over there, offering him $5,000 an hour to sit down on a recorded session and just walk through, Dave, why do you hate whole life so much? What's the purpose? You know, why do you think it's not a good tool and a vehicle to keep, build, and create wealth for yourself? Why are you so gung-ho on the buy term and invest the difference? As y'all know, Chris Noggle and Craig Yenny, they have gone through and mathematically debunked buy term and invest the difference versus the infinite banking concept. Reach out to me there as well. I got the resources and the training material I can send you too, but I just can't get calls back from these people. And yeah, you know, maybe they're stuck in their ways or whatever, but it's just something that I really want to make such a mainstream topic out there, because no matter what, you got to store your money somewhere. You have to keep it liquid. You want to protect it. And again, you want to keep the money that you're making. So my tax-free growth within inside of my policies, the government's completely out of my hair. So back to that example of my mama, when she puts money into that policy and it grew by 249, all of that is tax-free dollars to her. So I just think it has to do with the mindset. Remember our last episode not too long ago where I was talking about it's 90% mindset, 10% about the product or the implementation? That's really what it is. And that's the hardest part about what we do being IBC practitioners is just helping people rethink their thinking over and over and over again. And it's not a hobby. You can't treat infinite banking like it's I'm going to pick it up here, then a few months, put it down, pick it up here the next few months. You got to keep going after it over and over again, day after day, so that you're getting yourself in that correct mindset of not going back to the old way of thinking. So, oh, thank you, Dexter. Dexter saying Bronco is shy of 6,000. F-250 is over 6,000, or the Lightning. Good, ma'am. So I know I just kind of spewed out all these thoughts. As I mentioned, when I was in transit yesterday, and I just kept thinking about what do I want to talk about tomorrow? So as I was getting deeper and deeper into my book here, I was like, you know what? Let's kind of just bring a light to taxes. We're getting in here into December, and I don't know. Here's just some moves that I want y'all to start doing. All right. And start it today. Okay. So get out your pen and paper. Where's my pen? Get out your pen and paper. And here's what y'all need to start doing right now. Number one, start tracking your taxes now. Don't wait until it's April time. Number two, I would even have quarterly tax meetings with your tax professional. I want to go off on another tangent real quick, because that's what also pissed me off too. Why are we only meeting once a year? Hey, wouldn't you think it's a good idea that we should meet at least once a quarter? Why do I have to come and ask you to meet once a quarter? Anyways, I'm irritated. So start tracking the taxes right now. Don't wait till April. Have those quarterly tax meetings with your tax professionals. Ask them, what does the government want me to invest in? And when you're looking at specific investments to make, review your after-tax returns on those investments. So I would encourage, look into real estate opportunities, look into the oil and gas, look into clean energy. I did something earlier this year in January. I funded a clean energy deal that's going to give me half of it for tax credits, which is powerful. What did I say? Real estate, oil and gas. Shoot, there's one more I wanted to mention. Anyways, your tax professionals will know. but just look into it with that bonus depreciation. So, hey, and if you need me to, I'm here from a infinite banking standpoint. It's very easy on the tax side of things. Okay, so let's just touch on that real quick, because when money goes into the policy, that's after taxed money. So a question I get a lot too is like, Hannah, can I take like my 401k, just rip off the Band-Aid and put all the money into this policy? Well, you could, but hey, if you're under age 59 and a half, you still got the 10% penalty, and you're still going to have to pay the taxes on that money, because money or premium is paid with after-tax money. And then now once it's in the policy, now it's in that environment where it's growing tax-free for us. Okay, so that's really just the tax side of infinite banking and the whole life policies. And then anytime that you take money out of the policy, it's policy loans. Loans are not taxed in the traditional sense anyways, but that's all tax-free money to you as well. How I implement it, I have a separate segregated checking account at my bank, and all of my loan money, when I take it out of my policy, it goes directly into that segregated checking account, because it's just easy for tax purposes. You know, I'm not commingling it with my main account, so it's just easier to identify what's taxable income and what's not. when it comes to the tax preparation and tax side of things. And then also it just kind of keeps me disciplined, right? Because when I'm paying myself back or I'm paying myself first, I put that money into that specific segregated account because it holds me accountable. And then I also just do it for my own tracking purposes too. So IBC side, whole life policy, the taxes are pretty straightforward, very easy. As I'm sitting here and I'm thinking too, my beautiful ADD brain is going off. And I did a segment not too long ago on Money Mornings with Hannah where I got into retirement income using the policy. And you can strategically start taking out tax-free income from the policy as well. So go rewatch that episode. You can find it on the YouTube channels, The Money Multiplier, or if you search up my name, Hannah Kessler. I would recommend watching it on YouTube because I got deep into some illustrations there. But I think that's all of my thoughts that I really have for y'all right now. So just with the clarity and just to wrap it all up, the people who win financially aren't always smarter. They're just better informed if you kind of think about it. And it's not so much about the loopholes, it's about playing the game by the rules that the government wrote. And when you really start to understand the taxes, I just think the whole world just starts to open up. So I encourage y'all, go do your own deep dive. Don't just take my word for it. I'm still a student over here of taxes, okay? And if y'all know of some stuff that I don't know, please send it my way. I'm an open book. I want to learn right alongside y'all as well. And we can just make more impactful decisions. Oh my gosh, I didn't even talk about charitable donations. Duh. I do charitable donations every year to 501c3s, and that's some tax benefits as well. I have my own foundation. I want to do more with my foundation there. So it's just kind of fun because then it kind of gets you into a different mindset too of, I'm investing my money because I want to grow my wealth, but also I'm here and I'm helping out other communities and other families as well. And it just kind of puts a totally different perspective and even just like a positive shift on it all. So before I end here today, Mr. Dexter is saying most people, if they have never done it or don't thank anyone who has done it, they think it doesn't exist. Infinite banking is my life now. Thanks for sharing it. Thank you, Dexter, for that testimonial. All right. I'm going to go and drink a little bit more coffee. Get going with my day. I'm around if y'all need me. If you guys have questions for me, want to reach out, you have my email address, hannah@themoneymultiplier.com. So reach out to me, just whatever I can do. I did mention if you need some tax people and tax help, reach out to me and I'll connect you with those people who I trust and I'm personally working with. And then just a quick recap too. Come and see us in Tampa, y'all. What are you waiting for? What are you waiting for? Why are you waiting to come out here and meet the community and just learn deeper for yourself? Seriously. So come and join us, Money Game Live, Tampa, Florida, February 27, 28, and March 1st, okay? And for my VIP people, y'all, I got some fun stuff planned for you. You guys just wait. So with that being said, I still got more comments coming in. Mr. Shane, thank you. I see you, man. Keep your mind liquid and keep learning and sharing. Lisa's saying, think of me when you swim in that lovely pool. Thanks for sharing your knowledge and encouraging us to learn with you. Absolutely, my girlfriend. I appreciate all of y'all. So, hey, with that being said, enjoy your day. Happy Thursday, everybody. Do well, be great. And until next week, I will see all of you then. Bye, y'all.